Hello everyone. Today I'm going to teach you everything you need to know about analyzing a fixer-upper, whether it's a good investment and how to determine if it's worth your time and money. Before we get started, just a quick heads up. I will be sharing my personal experiences and what worked for me, but it's not legal or financial advice. My goal is to break everything down step by step so you can decide what works best for you in your real estate journey. So now let's get into it. If you are new to my channel, my name is Oberoi and I'm a real estate agent, investor and a serial entrepreneur. I went from working as a server to owning multi-million dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. Step 1. Location matters more than anything. When investing in real estate, location is everything. A fixer-upper in a good location is a gold mine, while a perfect house in a bad area can be a financial trap. If the neighborhood has a strong demand, your investment will naturally appreciate and your renovations will yield high returns. One of my investments was a fixer-upper in Cedar Hills, Surrey. This property wasn't in a great position to begin with, but I bought it because the area had a strong demand and upside potential. Homes in the neighborhood were selling for much higher renovations, which meant I could force appreciation through strategic upgrades. When you are analyzing a fixer-upper, always start by checking neighborhood. Ask yourself, are home values in this area appreciating? Are people moving into the areas or they are declining? What is the average sales price of a renovated home nearby? If the location is right, you are already ahead in the game. Step 2. Understanding the renovation cost and ROI. A fixer-upper only makes sense if numbers work. A common mistake investor makes is misunderstanding how much renovations will cost. Some properties only need cosmetic updates like paint and flooring, while others have major structural issues that can quickly eat up your profit. For my Cedar Hill property, I ran the numbers before making the purchase. My purchase price was 1.1 million. My renovation cost on that property was give or take about $150,000. Final investment after closing costs and renovation was about $1,250. I completed the entire house making high impact improvements. Added a rental suite downstairs to increase income potential. Updated the kitchen with the modern cabinets, quartz countertops and new appliances. Replaced old floorings to give house a fresh and a modern look. Upgraded the bathrooms with new fixtures and tiling. Enhanced curb appeal with fresh paint, landscaping and lighting. These strategic renovations increased the property value without any market changes. It wasn't speculation. It was forced appreciation by improving the property itself. After renovations, I received an offer for 1.4 million, giving me about $150,000 profit, but I didn't sell. Why? Because I knew I could get even more in a better market. Meanwhile, I'm cash flow positive every month because of the rental suite I added, meaning I'm making money while I wait for the right time to sell. Step 3. Running the comps before you buy. Before you even make an offer on a fixer-upper, you need to run comparables to ensure once you renovate the property, will it actually increase the value? Here's how you do it. I look at the homes that have sold in the last 6 to 12 months that were fully renovated. I compared their sale prices to what my investment will be, which is purchase price plus renovation costs. If the margin isn't big enough, I don't buy the property. For my Cedar Hill properties, the numbers were clear. Fully renovated homes in the area were selling for 1.4 million. My total investment was $1,250. That left me with $150,000 in profit. If you don't check comps before buying, you are just guessing. And in real estate, guessing is gambling. Step 4. Always have an exit strategy. A common mistake investors make is buying a fixer-upper without an exit plan. Before you even buy, you need to know, are you flipping it for quick profit? Are you renting it out for passive income? Are you going to be living in it for a while until you're fixing it? For my Cedar Hill properties, my original plan was to flip it. But since I knew I could get more money in a better market, I decided to hold on to it and rent it out. Because I'd added a rental suite, I now have a positive cash flow every month. So there's no urgency to sell. This is an important lesson. If the property doesn't sell immediately, you should still able to rent it out and make money. If the numbers don't work, either flipping or renting, walk away from the deal. Step 5. Which fixer-upper would you choose? Now let's apply everything I just taught you in a real world example. Imagine you have two properties in front of you. Property A, fully renovated, move-in ready, built in 94, 5 beds, 4 baths, about give or take 22 to 2300 square feet. Price is 1.7 million. Property B, outdated, need renovations, built in 94, 3 beds, 3 bath, about 2800 square feet. Price is 1.4 million. Which one would you choose? Most people would pick property A because it looks nice and it's ready to move in. But a smart investor would pick property B. Why? Because it has upside potential. You can renovate, add value, and increase the price, just like I did with my Cedar Hill property. A fully finished home in a hot market might not appreciate much, while a fixer-upper in the same area gives you the control over its appreciation. Instead of relying on a market speculation, you are forcing appreciation through strategic upgrades. So think about it. Are you making decisions like an investor or a home buyer? A fixer-upper can be one of the best investments you make if you analyze it correctly. Before buying, ask yourself, is location is strong? Whether it's in a growing neighborhood, good real estate value going to be tomorrow or not? How the schools are there nearby or not? Are the renovation costs manageable? There shouldn't be any hidden surprises. Does the after repair value justify the investment? Do you have a clear exit strategy? Flip, rent, or you going to live in? Are there no major red flags, legal structure, or neighborhood issues? If you follow this process, you make smart investment instead of emotional decisions. I have made 6-figure profits by choosing the right fixer-uppers. But I have also walked away from the deals that didn't add up. The key is knowing when to say yes and when to say no. If you found this video helpful, hit that like button, subscribe, and drop a comment below and let me know which property would you choose, property A or property B, and tell me why. Until then, I will see you next time. Take care.